And welcome in. We are indeed here for another great week of Retirement Redefined with Brad Gotto. I am Bill Seller. Brad is the head honcho, chief cook and bottle washer. Is that what we say, Brad? Or is it the
Yeah, all of it, all of the above.
founder and CEO of Fiat Wealth Management? Always good to see you, buddy.
Good to see you too. Another
Everything
week.
going, yeah, another week. Trying to teach folks about retiring, what it takes to get to it and get through it, and the great way that Fiat Wealth Management can help them do just that. So, as we get started, I always like to give out Brad's phone number. It's 952-522-3868. That's the number to Fiat Wealth Management. If you have saved at least $250,000 for your retirement, that's the number you're going to want to call to set up your visit with the good folks at Fiat. 952-522-3868. And coming up today, we're going to talk about a whole bunch of different things, like imagine working into your 90s because a clerical error denied you a pension. Oh, man. There's a reason for a little lesson there for all of us. Also, retirement confidence is sliding, and the numbers tell the story. We're going to talk to Brad about that as well. But I thought we'd start the show out today with the topic I know you enjoy, my friend, and that is cars. You're a big car guy.
Big car guy.
Just read a thing that said 4 in 10 drivers say that their car is their happy place. 42% claiming it calms them down and relaxes them. Well, they're not driving in traffic that I've seen.
Oh, if you just get in line and stay in line, it doesn't matter. I'm one of those people. I enjoy my commute. I have about a 25, 30-minute commute to work, and it's my time to wake up in the mornings and my time to decompress a little bit on the way home. So the work from home people, I don't get it. One, I'm not as productive there, and two, the drive to the home office is too short.
Yeah. But I thought of you when I read that. I said, yeah, Brad's a car guy. He'll
Big
enjoy
time.
this. He'll enjoy this. So I just mentioned the thing about working into your 90s because you didn't get a pension due to an error. Well, this happened to a guy named Luis Ramos in Jersey City. He worked into his 90s because he was told he would never qualify for a pension. Turns out that there was a mistake made, a clerical error that may have cost him decades of retirement benefits. So I only bring it up because I also know that most of us no longer have pensions, Brad. I mean, that's kind of a thing of the past. But what about ways that, I don't know, what are the things that we can do to help us guarantee some of that income in retirement besides a 401k?
Yeah, I mean, this story, it sounds kind of, when you first read it, this guy was still working because he'd worked for the city forever and thought he wasn't eligible for his pension. Come to find out after the fact, when his daughter started digging into it, he probably was. It sounds a little extreme, but honestly, it happens all the time. Whether it's government agencies or it's your local HR department at your job or whatever it may be, errors are made, and people need to understand that. I think we just all assume that if I have a job and I'm getting a W-2, that they're just getting everything right, whether it's your pay or it's your benefits or otherwise. And same thing with the federal government. And unfortunately, Bill, all too many times I've seen mistakes on both sides, not just at your local employer, which it seems more not obvious, or just seems more likely, I guess, in our brains. That's like, okay, I can see my employer making a mistake, but the federal government, like my Social Security calculations and that kind of stuff, there's no way they're making mistakes, right? Well, they are. They're all human beings, just like you and I are. And yes, they have systems and processes and things to follow, but that doesn't mean that they're perfect. And so the onus is on you to make sure that you're getting the benefits that you deserve. And so that's kind of point number one, is just double check your benefits, everything from your employer plans and benefits, and making sure that you're getting what you deserve. In the case like you just read, this gentleman didn't think he was eligible for a pension. So in his 90s, he was still working because he didn't think that the pension that was offered was there. Obviously, had he had that pension, knew he was eligible for that pension, could have retired a while back. That goes in the way of the federal government. I've had multiple people look into their Social Security records only to find out, Bill, that what your Social Security is calculated on is 35 years of, or 40 quarters. You have to earn like 40 points. Think of it that way. And every quarter of a year, you can get a point. So it takes 10 full years, 10 years of full employment to be eligible. But then your benefits calculated on 35 years of working history. Well, so the more you earn, the bigger your Social Security benefit's going to be. Of course, there's a max to it, but the bottom line is you just assume that the income recording that they're getting every single year is correct, that your employer is giving them the correct information, that they're inputting the correct information, and that no mistakes are being made. I've seen mistakes on that side too. People double check, they go into SSA.gov, they look up their records, they look at their earnings history, and they're like, yeah, that's not right. That's not at all what I earned in 2011. And to the point where, Bill, I've seen like just a zero is missing. And so instead of it saying I earned $110,000, it says you earned $11,000. Well, obviously that's going to dramatically affect your Social Security benefit and how they're calculating your Social Security benefit. So point number one, don't assume that somebody else is completely taking care of you and not making mistakes, okay? I guess point number two in that is don't forget about old accounts. One of the things, unlike other than just mistakes being made, it's just people forgetting that they have money. And now I know for a lot of us that seems a little ridiculous. Like, how can you
say I'd love to have that problem?
Yeah, exactly. But more people, that's true for more people than you would like to think. Same thing. I've had clients that have been clients for years and years walk into my office and go, hey, I just remembered I have this old 401k account from a job 4 jobs ago when I was in my 20s. Totally forgot about it. Only worked there for like 2 years. It wasn't that much money. And so I kind of forgot. Now here it's been 20, 30 years later, and it's way more money than I thought I had there or even remembered that I had. But now we need to put this into the plan. And so just being cognizant of that and understanding that, as we move around, we move jobs, your employer changes benefits. Sometimes it's just as simple as I'm still at the same job, but they change their benefits package. And so now, I've got a different place that I have money at the same employer. So things like that. And then the third thing I would say to this is just the guaranteed income portion, because we're talking about pensions here. And to your question earlier, which is guaranteed income is important. And obviously for this gentleman who didn't know he was eligible for this pension, it was the difference between being able to retire and not being able to retire. But for those of us, to your point, that don't have pensions, myself included, what should we be doing to kind of replace that? Because, back in the 70s, pensions started dying out in the 60s, dying out, the kind of the peak pension era was the 60s. And ever since then, it's just been less and less and less. Right. We were given 401ks and IRAs in the 1970s. There's positives to 401ks and IRAs over a pension. But one of the negatives, there's more than one negative, but the biggest negative is it's not a paycheck. It's a pile of money. And that can be positive in certain circumstances, but the negative to it is now the onus is on you to figure out how to spend it wisely over time, turn it back into a paycheck, and then not run out of it. One of the things we lose out on with it being a pile of money is the guarantee that you can't outlive it. Whereas with a pension and Social Security, as you know, it's going to be there until you die. And so pros and cons to both sides. But one of the things most Americans are missing is enough what I call mailbox money to kind of make the plan work. Because when you're in distribution, Bill, you think about it, there's really only 2 types of income you can provide to yourself with your savings: guaranteed income and non-guaranteed income. Both have a place. And depending on circumstances, how much of each to kind of make up your cash flow needs and what's appropriate is going to be different per person. But I would just say this: they both have a place. And so the majority of people that walk through our doors, Bill, are light on the guarantee side and heavy on the non-guaranteed side. And so finding a way to take some of that pile of money and turn it back into a guaranteed paycheck, the way that a pension would be or Social Security is important for a lot of Americans. So a lot to take from this story. Number one, understand that people make mistakes, and to make sure that you have the correct benefits coming to you. Number two, don't forget about money that you have lying different places. And number three, understanding where guaranteed income can or should fit into your overall plan and what percentage makes sense for your family is going to be based on 2 things: kind of your wants and needs and the numbers, but then also your personal opinion and how you feel about things. There's just a lot of people that if the money's not guaranteed, they won't spend it.
Right.
And so in order for you to actually live the lifestyle you want to live in retirement, it has to come in the mailbox, and it has to come every month as long as you live. And if it doesn't, and it's just sitting in a savings account or in an IRA, you won't spend it. And so understanding who you are as a person and behaviorally how you feel about money is going to be the other side of that coin that we need to take into account when it comes to planning. And so bottom line is, it comes down to planning. Part of the planning is making sure we understand where all of your money's at, that all of it's being calculated correctly, and then putting it together in a way that makes sense for your family.
And if I'm not, I believe there's actually a place you can go to see if you've forgotten a 401k, right? There's a website out there called lostandfound.gov.
Yeah.
Or, of course, you can always call an old employer and go, hey, did I leave something behind? And they can look it up for you. But I've never had that problem. Whenever I've left a couple jobs, I make sure I take it all with me. But that would be shocking
there
to
is
get
a
that letter
website
in the
out
mail.
there.
Yeah.
Yeah, there's a website out there. You're going to need to create an account on the website. It's a government website if you haven't already. And of course, you need information, personal information to be able to, to verify who you are, driver's license type information to be able to create an account there. But if you have any questions on that website, how it works, and want to look into it, feel free to reach out to us. It's something we can help with.
Just curious, the guy that came in and said, hey, I had from 4 jobs ago, or some of the other folks you've heard, has it been pretty good money? Or is it just like a little bit that they forgot about because they weren't there long?
I've seen both. I've seen 6 figures of money and I've seen a couple grand. You know what I mean? But it's really nice. It's one thing to find $20 in your winter coat, the following winter. It's a whole other thing to find 6 figures of money you forgot about.
Absolutely. That's what I was thinking. I'm lucky when I put on my jacket and find a little cash in there. Oh, let me give you Brad's number again. It's 952-522-3868. 952-522-3868. These are all things that can affect your retirement. And like Brad said, the number one thing is knowing where all your money is. So when you're putting together that plan for retirement, if you saved at least $250,000 so far, give the good folks at Fiat a call, meet with Brad's team of highly trained fiduciaries, and let them sit down and visit with you and make sure that you've got a good handle on where you want your retirement to go, and they can help you put that plan together. So to get your complimentary retirement consultation, give them a call at 952-522-3868. We have to take a break here, but when we come back, we're going to talk some more about Social Security and the COLA, and why is it or is it not keeping pace with inflation? And Mark Cuban bailed on Bitcoin. Was he right, or did he panic at the worst time? We're going to talk about that as well. Got a lot more to come. This is Retirement Redefined with Brad Gotto and Fiat Wealth Management on Twin Cities News Talk 1130 and 103.5 FM. And welcome back. Thanks for spending part of your weekend here with us, along with Brad Gotto from Fiat Wealth Management. I am Bill Seller, and here's something you don't see every day. Folks in Detroit got to see a priest running through the streets chasing down a car thief. He was working, and he heard a squeal of tires and then a very loud crash, and he ran outside to see what was going on. And he saw a bunch of guys running down the street from the scene of that crash, and he full priest garb, the whole thing he's got on, and he's running down the street, tackles the guy, and he winds up being arrested for trying to steal a car. And the good father said, I hurt my hand a little bit, but I just wanted to make sure that there was no weapon and somebody else would have gotten hurt. So there you go.
Well, he ran after the guy to figure out if there was a weapon or not?
Yes.
That makes sense.
Yes. Well, he in his business, he must have had faith. He must have known that, that's going to be a new Marvel character in the next movie. Who knows?
Yeah.
Superhero priest. Your Social Security check got a raise this year like it does every year, right? What was it? I think 2.8% cost of living adjustment. But here's the problem. Inflation is already way ahead of that increase. So in real terms, Brad, retirees who rely mostly on Social Security are already kind of losing ground, aren't they?
Yeah.
I mean, it's built to actually protect retirees from inflation, but not in today's world. That's not happening.
Well, yeah, for the most part, it doesn't do a super great job. Hopefully for retirees, this isn't your only inflation hedge. Because the government measures inflation one way and retirees often experience it a much different way. In fact, if you want to be super technical about it, I'm not going to get super deep on this, it's measured by the CPI, but there's multiple subsets of the CPI, with the Consumer Price Index, which measures inflation. But think of it this way. Think about like a grocery cart, and you put different groceries in your grocery cart. And depending on what is in your cart, inflation is going to hit you different than it's going to hit somebody else, depending on what they have in their cart, because not the entire grocery store is getting inflated at the same clip, as an example. My wife would tell you that produce is getting absolutely nailed with inflation right now. She loves to complain about the price of fruit specifically. But that being said, now expand, same concept, grocery cart concept, but expand it beyond to everything in the economy. And what you put in your quote unquote grocery cart of living expenses each and every month is going to be different than your neighbors. So you're going to experience inflation a little bit differently. The interesting part about the government is that your cost of living adjustment on Social Security is measured by the CPIW, which is a subset of the CPI. specific to workers. That's the W. Well, unfortunately, workers and they're, a 35-year-old is spending money on childcare, commuting, and work expenses, and a retiree is spending money on healthcare, prescriptions, insurance, and home services. Well, if you're measuring it off the basket of goods that the 35-year-old and the workers are spending their money on, it's usually not going to match up. And unfortunately, usually not to the positive. Usually what we get or what retirees get when Social Security is turned on for a cost of living adjustment does not keep up with the basket of goods, because the one thing that's in their basket that's not included in the index is healthcare costs. Well, we all know 2 to 3% a year is not keeping up with the cost of healthcare. You don't have to be an economist to know that, right?
Why don't they add that in there? I mean, it's obvious.
Because they know it'd be more expensive, and they already can't afford the cost of living adjustment that they give. I mean, that's my 2 cents on it. I don't have like a white paper that proves that out, so don't take that as gospel. But that's my 2 cents. That's why they did it that way. The bottom line is this: inflation's a real thing. We all know that. In fact, it's built into our ecosystem. It is assumed we're going to have inflation. We're not trying to get to an inflation of 0. And so knowing that and knowing that it's going to be there consistently over time, now we don't know exactly how much and what specifically is going to be inflated, but for retirees, how do you defense against it? Well, there's no perfect defense for any of this stuff, whether it's inflation, longevity, market turmoil, or whatever it may be. But one of the ways to diversify or is for income to get rid of inflation risk is diversification. The same way it is for tax risk or market risks, longevity risks. How do you diversify against inflation, though? You diversify where your income is coming from. And so hopefully Social Security is a part of that, retirement accounts, investment income, like things like interest income or dividends, pensions, sometimes annuities can be a part of that. Part-time work could be in there if need be. But the bottom line is the more kind of different areas or sources that your income is, where your income is coming from, that diversification can lead to at certain times, just like any other part of diversification. If I have a stock portfolio with 10 stocks in it, while one is tanking, another one could be doing amazing and kind of offsetting the loss of the one stock. The same is true for your income in retirement. While one may not be performing particularly well in a year to hedge off things like inflation, another one might be. And so building out cash flow plans and income plans that are cognizant not only of how much you need today, but how much you might need tomorrow and how long you might live becomes vitally important. It's actually at the core of the work that we do here for our pre-retirees and retirees. Isn't just asking the simple question of how much income do you need and then dumping it all into one vehicle so that we get that amount of income per month to provide the income for the family, but finding creative ways to diversify it against not just inflation. This just happens to be what we're talking about in this segment, but other risks like, again, like I talked about before, inflation type risks, longevity risks, market-based risks, all that kind of stuff. But at the end of the day, Social Security is not going to keep up. I wouldn't expect it to keep up. Don't build that into your plan. Expect it to basically always kind of lag real inflation of how you choose to spend your money, or you're forced to spend it on things like healthcare, and then build around it.
So when you guys sit down with people and you do this complimentary retirement consultation, and then you start building their plan, there's an inflation number in that plan, right? I mean,
we start with an inflation number. I mean, you have to start somewhere. Historically, if you look over the last 50 years, 3 is a good number to use. Now, we've experienced more than that recently. And so recency biased, we get a lot of people that come in here and want to use a much higher number. They're like, 3 is not enough. And it's like, well, I understand the last handful of years we've experienced more than that. But if you look at the last 50 years, we haven't. And we've had ebbs and flows in there. Part of the last 50 years is the 1970s. In the 1970s, we had hyperinflation going on for almost a decade.
Yeah.
And so it's always going to ebb and flow, and we need to be prepared for that. But at the end of the day, 3 is usually a pretty good jumping off point. If you want to be hyper conservative, you can go to like 3.5%, maybe 4%. But I'm telling you, if you ran your retirement plan at a 4% inflation rate, you'd be very distraught of how big of a difference that makes from, to go from 3 to 4% a year, as an example.
Wow. Okay.
But something to be cognizant of.
All right. Again, the number is 952-522-3868 to get your complimentary retirement consultation with the good folks at Fiat Wealth Management. If you have saved at least $250,000 so far and want to see what your retirement can start looking like, well, that's where that complimentary retirement consultation comes into play. The highly trained team of fiduciaries there at Fiat will sit down with you, find out what you're hoping to do in retirement, and make sure you understand all the things you're going to have to deal with in retirement. We've talked about some of those already, right? Healthcare costs, inflation, taxes is another big one. You have to have a good handle on all of that. And folks, what I love about doing this show is that I'm not a licensed financial guy. I don't know jack about this business. So I love doing this with Brad because I do learn things, and I'm just like you. I walk into his office, sit down, talk with he and his team, and figure out what they can do to make you feel a little better about where your retirement is headed. 952-522-3868 is the number. So I mentioned Mark Cuban bailed out of Bitcoin lately. He was saying that it lost the plot. It wasn't doing its job as an inflation hedge anymore. I mean, what gold just soared past, what, $6,500 or $5,000 an ounce, excuse me. I don't know why I said 65, but $5,000 an ounce. Bitcoin dropped. Do you have anybody ever coming in talking to you about that, and then you have to say, well, maybe something else is a better idea?
Yeah, I mean the darling right now is SpaceX, not Bitcoin. I mean, but there was a while there where Bitcoin was the darling, and it was the conversation that everybody was having. And what's interesting is when that stuff kind of picks up and catches steam, everybody develops FOMO, and they don't want to be the one that's at the dinner party that didn't invest in Bitcoin, and your neighbor, invested $5,000 and now it's worth $100,000 or something like that. So, I mean, the thing that's interesting to me about this is you need to understand them first of all, Mark Cuban can quote unquote invest in Bitcoin and be wrong and be just fine.
Yeah.
So most retirees can't. We don't have the luxury of going, I'm just going to dump a couple $100,000 at something or $1 million or whatever. And if it works, it works. If it doesn't, it doesn't. No sweat off my back. So a little bit, be careful there. So regardless of Mark Cuban's opinion, just because he was very successful and started an internet company 30 years ago and sold it for $1 billion or whatever it was, doesn't mean he's right about all this kind of stuff or that he's an expert when it comes to these sorts of things. It's just interesting to me when you look at people that have made their wealth and become billionaires, we just assume they know everything about everything. So that's kind of point number one. Point number two, retirement is the wrong, how should I put this? Retirement is the wrong time to need to be right.
I get it. Okay. I know what you're saying. Yeah.
Guesswork. This isn't the time to be guessing. This isn't the time to be like, you know what? I'm going to take a flyer on something. Because the closer you get to actually having to deploy the money to do something, the more painful it is to be wrong because you don't have the luxury of time to let things rebound or come back or to make more money because now you're not working and to kind of fix or correct these mistakes. And so the mindset just has to be a little bit different. I'm not saying go completely defensive and you go completely away from stocks or you're hyper conservative or something like that, but there needs to be both sides of the portfolio, right? We can't go completely on the offensive and leave nobody behind for defense just in case the offense doesn't work, right? I just got this last week, the NBA finals came to a close, which I don't know how you feel about the NBA and NHL finals. I watch both of them sporadically, but Jiminy Criminy, they take forever. It's like months and months just to get through the playoffs. But
right.
I always think like basketball, if you just sent all 5 guys down, after a missed shot and didn't leave anybody to rebound or anything like that, like it could work. It could work. In fact, there's a famous college basketball team in the state of Iowa, a small little D3 school that does that. They leave 2 guys on offense at all times. They only put 3 guys back on defense because they're just trying to cherry pick and get. Anyway, I got completely derailed there. But the bottom line is you have to play both sides of that. The last point I want to make on this is not just retirees, but it's true of retirees, often can confuse investing with gambling or speculating. Because what Mark Cuban was doing was speculating. He's just assuming that this is going to be just like gold in the future, and it's going to be this inflation hedge, and so I'm going to put a bunch of money there because it's going to replace what gold has been in our economy for the last couple hundred years. Again, investing in a company is sticking around for the long term and not betting on short term, one quarter's earnings or how it did over the last 12 months or something like that. If you're going to invest in a company, I always ask this question: do you take another big Mag 7 company that didn't just IPO, take like Meta or Google or something like that, and they take a hit over the last 6 months, and they're down 10%. You're like, oh my gosh, I just lost 10%. Well, do you think that Meta's stock price is going to be higher or lower 5 years from now than it is today? How about 10 years from now than it is today?
Odds are good.
The answer is higher. Then you're an investor and you stick around. and you stick around for the bumps and bruises. You want to get married to the company, get married to the company. You don't divorce it every single time it leaves the toilet seat up, and so being an investor is really, really important, especially when you're in distribution mode. But in order to be an investor and to stay invested, you have to have a plan centered around the volatility that goes along with being an equity investor. And so building hedging around that to understand that in the short-term cash flow needs and things like that are not going to be solved by equity positions. And if they are, you are going to be forced to sell at times at some of these positions when we don't want to. And now we've automatically turned ourselves back into a speculator or a gambler simply by the nature of the fact that we didn't have a plan in place, even if we don't want to be, kind of forced selling. So there's a lot to take away from it. One, we're not Mark Cuban. But number two, Bitcoin or otherwise. And I know I didn't really address Bitcoin specifically, but take out Bitcoin and put anything else in there. Yeah. We can speculate all we want, but wealth is lost in concentration. It can be. And so staying diversified, I'm not saying you can't own Bitcoin or you shouldn't own Bitcoin, but it's definitely not a core piece of a portfolio. And it's definitely not a financial plan to be buying and selling Bitcoin based on the timing of things and when you think it's going to go up or you think it's going to go down.
Despite what your friend at the cocktail party said. Just always keep that in mind.
Those are way more fun conversations. I'll admit it. Like it's way more fun to have those conversations about money you made or lost, but it's definitely not a financial plan.
And your financial plan starts with that phone call to 952-522-3868. 952-522-3868. That's how you reach out to Fiat Wealth Management. If you have saved at least $250,000 for your retirement and want to get that complimentary retirement consultation, no obligation. You just go in, you sit down, you talk with the highly trained fiduciaries at Fiat and let them see what they can tell you about where you're headed in retirement, because this is what they do, and they do it very well. Give them a call, 952-522-3868. Coming up after the break here, retirement confidence is sliding. What is driving that, and what can you do about it? We're going to talk to Brad and find out. This is Retirement Redefined with Brad Gotto and Fiat Wealth Management on Twin Cities News Talk 1130 and 103.5 FM. Welcome back. Welcome back. Thanks for being here and listening this morning. We do appreciate you spending part of your morning with us. And again, Brad's phone number to reach out to him is 952-522-3868. That's how you get in touch with the good folks at Fiat Wealth Management. And we do have people waiting right now to take your call and help you set up that visit. This call only takes a minute. It's not a very long call. You just make the appointment and go in and visit with them and see where your retirement goes from there. But I mentioned before the break about people kind of losing faith in retirement or that it's not looking the way they hoped. And here's a number that might back that up, maybe stopping your tracks a little bit. Americans now say that they're going to need $1.46 million to retire comfortably, Brad. And that's up more than 15% from just a year ago. First of all, do you think that's part of the inflation talk we just had and people are seeing what it costs to do that? Or is that a real number? Do you need that? Yeah. Although I'm going to start the answer for you. It depends. I know that's coming somewhere in here.
I'm glad you've learned something.
I have learned something.
As we've done this show together for, I don't know how long it's been, but a while. To me, it's just the wrong question. It's a question that you can write an article about, which is, why they asked that question, because it's good fodder for an article, but it's just the wrong question. The better question, and the first question you should be asking yourself, is how much income do I need? Because you can have two retirees with the same pile of money, $1.5 million, and have completely different retirements. Because if, the lifestyle of, client one is $5,000 a month and they're completely happy and doing whatever it is they want to do on that $5,000 a month. And then you got client two that wants $15,000 a month. Well, that 1.5 million spends a little differently when you're supposed to be taking 180 grand a year out of it versus 60 grand a year. And so it's just the wrong question. So these articles are, again, great fodder. They make for good articles for places like Yahoo Finance or whatever, or Forbes. But I think you just need to ask yourself the question of how much do I need to maintain the lifestyle, or how much do I need to live the lifestyle that I want to live? And is that going to look different in retirement? And so understanding, when you stop working, things change, you guys. And the biggest of which might be healthcare. You go from a employer-sponsored plan into your own healthcare or into Medicare, depending on how old you are when you retire. And understanding that you now have 40 hours a week or more that you have for free time that you didn't have before. And, sometimes free time's not free. You get bored and you want to go do things that cost money, whether it's pickleball or golf or, whatever it is that you want to do. And so just really kind of spending some time on what that budget needs to look like. And then we can reverse engineer that into the question of, well, how much do I need to maintain current lifestyle? The other interesting part about that question to me, Bill, is like, if, they need 1.5 million, we have people that walk through our door, Bill, that don't need any. They need zero to retire. And you're like, well, what? How does that make sense?
Yeah.
Well, because they live simple lives. And I don't mean that as a bad thing. I mean, it is, a compliment. And between a pension they might still have, I know we talked in previous segments, they're kind of a dying breed, but they're not dead yet. Some people still have them. And between pensions and Social Security, they literally have more money coming in the door every month than they spend. So an article like this doesn't take into account those people at all. They literally need zero. That's assuming, of course, that life doesn't throw them a massive curveball and they need 50 grand of cash, for a massive emergency or something like that. But you kind of get my point.
Right.
I think the next point I'd like to make here is just that most people overestimate the number and kind of underestimate the planning that goes along with it. I think it's so interesting that we work for 20, 30, 40, 50 years to kind of learn how to save and to save money. And then about 15 minutes, figuring out how to spend it. Like, we just put no time, energy, and effort of like, okay, now that the wealth exists, how to kind of put this back into my life in a meaningful way and make sure that I have enough. And a lot of times that 15 minutes is spent going, well, according to this article, it takes about 1.5. I got 1.5, so I'm good. And that's about it. And I guess kind of the last thing I just want to mention here is of all the factors that are going to affect that number on an individual level, outside of just budget of what you need in that 1.5 million, is longevity. And so when you start to think about this number, longevity is the one kind of unknown that in a compounding fashion affects every other variable. Because the longer you live, the more money you need. The longer you live, the more inflation's a problem. The longer you live, the more healthcare issues. The longer you live, I mean, you just name it. Keep going. And so whether you're planning for 20 years, 25 years, 30 years, some people 35 years of retirement, it's great. It's a really good problem to have, to live a long life, but it needs to be planned for. And so I just can't stress enough, don't get stuck on that number at all. And what these articles say, start with your budget, start with your comfort levels, margin of safety you want built in, stuff like that. Understand longevity inside of your family, and then build a plan around it.
Yeah, and I found it interesting too that in this same report that more than twice as many retirees that have a plan in place are more confident than those that don't have that plan. And
yeah, in fact, I'll give you the numbers because it's a really good point I forgot to bring up. It's a study that Fidelity did. It says 83% of people that had financial plans felt confident in their retirement. 38 felt confident that didn't have a plan. So massive, massive difference. When you look at the value of hiring an advisor, fiat or otherwise, you guys, this is the value, is that confidence factor of being able to sleep at night going, look, I've got all this kind of mapped out to the best of your abilities, of course, because you don't know what's going to happen in a lot of areas and you have to make assumptions, but mapped out to the best of our abilities adds to that confidence level by more than 2 times per Fidelity study.
Look, the way I look at it, it's no different than going to the grocery store hungry without a list. Right? If I go to the store with a list, I'm in and out, I get what's on the list and I'm good. But if I go there without a list and I'm hungry, I wind up, with a lot less money in my pocket because I spent things or bought things I don't really need. So think about it that way, right?
And a lot of food that's not healthy for you either.
No. Well, yeah, that's...
Nobody goes to the grocery store hungry and buys extra broccoli.
Exactly. Good point. But my point is, see, a plan is good no matter what you're doing. And if you go into retirement without one, I just think you're asking for trouble. So here's the number again to start working on yours with that complimentary retirement consultation at Fiat. 952-522-3868. That's their number. 952-522-3868. If you've saved at least $250,000 already for your retirement, give them a call, get on the calendar, and go in and visit with them and start working on your retirement plan, because that's what they do there. It's about a plan, not a product. And a plan is what's going to get you through your retirement. 952-522-3868 is that number. So along with what we're talking about there with that big number, retirement confidence, is failing We talked about a lot of the reasons why today already, debt, rising healthcare costs, housing prices, all of that stuff. Brad, where do you even start when so many things kind of feel out of your control as you roll into retirement?
Yeah, one of the biggest mistakes I think, pre-retirees and retirees make is they try to solve it all at the same time. And when we do that as human beings outside of your financial life, this is true everywhere, we just get overwhelmed and then we just do nothing. I'm sure you've been there, right? Whether it's housing projects or the laundry, when you look at the pile of laundry, you just get overwhelmed. And so you're just like, yeah, I'm not going to start, because just to start seems daunting. And so the first thing to do is just kind of work through what makes the most sense as far as like, what problem do we solve first? Don't try to solve every problem or risk or unknown at the same time. And so you were talking about kind of debt and people coming into retirement with debt and what it's, that's a problem these days. And so maybe that's the place to start for your family, is kind of that debt repayment, debt reduction plan. And let's just solve for that first and then kind of move on. It makes me think of, we had a prospective client come in the door. This is probably like 3 years ago now, had just sold the company. And so had just come into, because they had sold the company, obviously just came into a pile of cash and just had so many questions, like massive questions of what to do, and was so overwhelmed that was paralyzed. And in listening to the situation and this particular woman's concerns, we just kind of paused her and said, look, of everything on your list right there, the thing that we believe to be the most kind of important or on fire right now is your estate plan, because now your net worth just changed dramatically overnight. At least your liquid net worth did. An asset that you currently used to own, your business, you don't own anymore, but now you've got this pile of money. Your estate plan needs some serious work for all these reasons, and listed all the reasons why we thought that was the logical place to start. And she agreed. So what we did was we paused all the rest of the planning, and we got an estate planning attorney involved and walked through that and checked all those boxes that we needed to in that area first, and then moved on to the next kind of most important thing on the list. But just being able to, not that estate planning is simple, because it's not, especially for a situation like she was in, but at least the simplicity of working on one thing at a time was enough to kind of keep the ball moving forward. It was because she was kind of stuck spiraling that nothing was happening. The second thing I would say here is just focus on what you can control. Too many people get too stuck, Bill, and I don't want to be like too soapboxy about this, but they just get stuck in things they can't control anyway. And then instead of actually working actively on things you can control that can make a positive impact in your overall life or plan, they just get, work. All their energy, mental energy, is stuck on the things that are out of our control. We can't control inflation. You can't control Congress. You can't control Social Security reform and what they're going to do or not do, and if it's going to be funded in 2032 when it goes broke or not. You can't control interest rates. You can't control the market. Yeah, these are the things that keep people up at night. What you can control is how much money you spend, how much you save, your debt reduction schedules, when you choose to retire, your retirement age, if you will. You can control your tax planning and, minimize, or be efficient about what we pay the IRS, investment discipline, kind of philosophy, all these kinds of things. So just focus on those things. And the last thing I just want to say is most retirees don't, at least recently, kind of this phenomenon I've been seeing is they're retiring earlier than they expected to retire. And a lot of it, Bill, is just changing careers, like changing landscapes. A lot of people are, older, more long in the tooth in their careers, are being let go, or their jobs are being, eliminated or something to that effect. And so it's just important to understand and be prepared for that as well, and make sure that when we're kind of going through these lists and putting things in lists of importance, focusing on the things you can control, is building in some flexibility for this possible early retirement. And I know that's a little bit ancillary or adjacent to this conversation, but it's just something I've seen a lot that I want to bring up to the listeners. It's just build it in as kind of a plan B. Like, what if I want to retire at 65, but I get pushed out at 62 or something like that? How does that work for us, and how do we build a plan around that?
Yeah, it's, again, you keep hearing the word plan, right? I mean, it's all about planning. And it's all about understanding how yours works, or even getting yours started, which is why we get together every week to let you know what the good folks of Fiat Wealth Management can do for you. Because here's the thing, you've worked very hard all these years and you've put all that money away, or like the good folks of Fiat always say, you've worked really hard to climb that mountain. And now when you really need help is to get down the other side, right? When you shut the door in your office for the last time, or you stop driving a cab or get out of that truck or whatever you do for a living, suddenly now you've got to live on all that money you saved. Well, that's where that complimentary retirement consultation comes into play. They're going to sit down with you. They're going to show you the things you'll need to be ready for in retirement while hopefully helping you set up a plan to achieve the things you want to do in retirement. But it all starts with a phone call. And that number is 952-522-3868. 952-522-3868. That's how you set up your visit with the good folks at Fiat Wealth Management. If you have saved at least $250,000 for your retirement, go in, talk with the highly trained fiduciaries there, and see what your retirement can look like. Because without a plan, it's going to be a little foggy. That's all I'm saying. We got to take a break here. Vanguard just released a retirement income playbook. And the most important number is not your account balance. That and a few more things before we get out of here today. This is Retirement Redefined with Brad Gotto and Fiat Wealth Management on Twin Cities News Talk 1130 and 103.5 FM. Excuse me, I didn't mean to snort in your ear there.
No worries.
Man. Okay. Here we go. All right, we are back rolling into the last segment already. Boy, this show flies by every week. I am Bill Seller along with Brad Gotto of Fiat Wealth Management. And boy, if this isn't a sign of the times, and he actually got away with this, I'm not really sure how. Some guy in San Francisco robbed a yoga pants store. First of all, it's a store dedicated to yoga pants. Guess it makes sense in San Francisco. But anyway, but he got there, stole the pants, and then got away in a Waymo, one of those driverless cars. So he took the car to the store, told it to wait, went in, robbed the store, and they can't track him down. I mean, you would think that with all the GPS and the cameras on these cars, they can't find him.
Yeah, that doesn't make a lot of sense.
But I mean, boy, if that is not like a current crime, I don't know. I don't know what is. So.
That's got to be about discovery, right? And maybe they just can't legally ask for discovery for the I don't know, because that makes no sense.
Yeah, but all the traffic footage shows him, but they just for some reason never got a good look of him, so they couldn't. They don't know who it is. But anyway,
all right.
And that takes some trust in the driverless cars. I just saw.
If I was ever gonna commit a robbery, which is a pretty significant crime, I for sure would be for yoga pants.
Right. Because that's worth throwing your life away for. 952-522-3868. That's how you get in touch with Fiat Wealth Management. Anything you've heard on the show today, or if you just want to talk about what your retirement could look like, give them a call. As I mentioned before the break, you spend decades saving for retirement. You know, you've watched your balance grow, but Vanguard just released some new research saying that the size of your nest egg may not be the most important factor in whether or not your retirement plan succeeds. So, see, first time. Well, there's a bad joke there about size doesn't matter, but I'm going to move on from that because I'm a better man. The number that actually matters most: how much you withdraw each year, Brad. You agree with these guys, or?
It's an important one. I don't know if the most is and I struggle with language that's like always and never.
Yeah.
The most just assumes, again, it's a blanket statement, but yeah, it matters a lot. When you think about, I mentioned this earlier in an earlier segment when I said 1.5 million and somebody's withdrawing, $5,000 a month versus 15, $60K a year off of 1.5 versus 180K a year, which is more than 10% per year. It matters. If you go all the way back to kind of the beginning of this thought process, was a study that was done by Harry Markowitz, won a Nobel Prize for this study, actually. Still used in a lot of ways today, about the safe withdrawal rate in retirement. How much can you safely pull out and not run a high risk of running out of money? The number he came back with was 4%. And so that's been the rule of thumb in our industry for the better part of 30 years. That being said, that's not always true. In fact, Markowitz himself has updated his study multiple times and, gotten a little more squishy on that number, if you will. It's not like a standard 4%. A lot of it's driven by interest rates and markets and things of that nature. I've seen studies as low as 1.8. Now, if you think about that, Bill, that means if you have $1 million portfolio at 1.8, it's $18,000 a year. which doesn't sound like a great lifestyle off of
Not
$1 million.
really. Yeah.
I've seen it north of 5, depending on the studies and the assumptions that you make. So does it matter? Of course it does. The more aggressive you're going to be about it, distribution rates of 5-6% per year, you're just dramatically increasing the odds that you run out of money. Whereas the lower you go, as a percentage of your account balance, the greater the chance you're increasing that your money outlives you in some capacity. And so, yeah, it matters a lot. A couple of things to keep in mind with it are understanding the assumptions that are being made to get you to your safe withdrawal rate and being comfortable with them. Because at the end of the day, all planning, no matter what topic we're talking about, Bill, is you just being comfortable with the risks that you're taking, but also understanding them. And so whether it's like we've talked about, whether it's understanding the longevity risk you have, the inflation risk you have, or just what can throw your plan off, and kind of building in the margin of safety that helps you sleep at night is what's important. And so I think we always have to start with education on these types of things, and then lead to data-driven decisions after we've educated based on how you feel. So anything as low as 2.5, all the way up to 4 or 5, depends on how old you are when you retire, depends on inflation rates we want to bank in, depends on the percent chance you want of running out of money that you feel comfortable with. Like, do you need a 99% chance of success in your overall plans to feel good? Or are you okay with like a 90% chance, as an example? Because that's going to make a big difference as well. This is all kind of part of the planning that we do, is not just understanding. In fact, in our standard cash flow sheet that we give to all of our clients from a planning perspective, one of the things that's built into that cash flow sheet, Bill, because it's important to pay attention to, is distribution rates. How much of your pile of money are you pulling out every year? And it's also really important to understand that that number moves a lot. Because if you're, as an example, Bill, if you retire at 65, but we don't turn Social Security on right away, well, if I don't have that coming in the door and I want, $5,000 a month to live on, but I've got nothing coming in the door, I need $5,000 a month from the portfolio. That's going to equate to 1 distribution rate. Well, if 3 years from now you turn Social Security on and it provides 30 of the 50 that you need, or 60, $5,000 a month, well, now I need a lot less from the portfolio. It's going to change my distribution rate. And so we look at it every year. What does the distribution rate look like year over year? And then what does it look like on the whole, or on an average from a portfolio perspective? So it's definitely a number we pay attention to. The biggest piece of advice I can give retirees is this: you have to be flexible. We all get this idea in our head, Bill, of like, well, I'm going to retire at 65 when I retire. These are the things that I'm going to do. Well, then life throws you a curveball, and it can't work out that way. You don't have as much money as you thought. You retired in the middle of a recession. You had some healthcare expenses come up, or whatever the litany of things that could happen. We just need to be flexible. And we've all dealt with that before, Bill. I'm sure you've been through it. I mean, my wife and I, when we were, younger and just starting to have kids, realized, one, how expensive kids are, and two, was just at a stage of our life where money was tight anyway.
Yeah. And
then we had a couple things happen that made money even tighter. And then we added a kid to the scenario. And it was basically like, I felt like I was out in the middle of the ocean drowning and somebody threw me a kid. And I'm like, oh, that's not what I need. And so you just have to be flexible. So my wife and I had to cut lifestyle pretty dramatically, certain things that we were used to. You may have to retire later. You may have to spend less money certain times. You may have to do all kinds of things. I think the biggest mistake retirees can make is just not being flexible. They get there, they have a certain set of assumptions built in. They think, well, this is what I'm going to do regardless of how the markets perform, how Congress acts, how inflation plays out, how my health plays out. Just like in your working years, we need to be cognizant of the money that can be coming in the door from a healthy perspective, and not overspend in the early years or underspend when we can be spending, and things of that nature. So work with a financial advisor. Here's my piece of advice: that's willing to tell you no, or willing to give you the hard news. One of the things I think my industry is not very good at is we're yes men. If the client says, well, I want to invest in this particular stock, and we just like, okay, if that's what you want to do, do it. Or, well, markets are down, your portfolio's off 25%, and I'm just going to let you keep spending the $10,000 a month that you're spending, even though it's massively stressing the portfolio right now. Instead of telling you, hey, we should probably cut back on some discretionary spending when the markets are down, or something to that effect. So finding an advisor that's willing to actually be a good advisor. And part of being a good advisor, in my opinion, is being able to tell a client when the plan's not going according to plan and that we need to pivot.
Well, I think we all need that in our life in so many ways, right? And like you said earlier, being flexible, I think that's a big deal in life as well, right? I mean, people
Yeah.
who are rigid wind up having a real hard time if you can't go with the flow, as they say. And I'm not saying on everything, but you've got to be able to bend or you will break. And
Yeah.
and I think that thinking that way about retirement and the things that Brad just said makes a lot of sense. And so does calling the good folks at Fiat Wealth Management to talk more about what they can do for you with your retirement plan, with the plan that they put together for you. So if you have saved 250 grand or more for your retirement, give them a call at 952-522-3868. 952-522-3868 is the number. Before we get out of here, I also read something recently that a lot of folks don't think that they're going to, well, let me restart that by saying the American dream, it means different things to different people, right?
Yeah.
Owning a home, financial security, freedom, opportunities. But there's a striking new number out from this article that I read, and it says 26% of Americans say that they have achieved an American dream. 31% say that they never will. Not with that kind of attitude, you won't, young man, is what I hear my dad in my head saying right now. But it's like, but I got to believe that what we talk about every week and all this planning, I bet that's a lot of what's involved in making those 26% people think that they have. You know,
Yeah, I
planning
mean,
and
at the end of the
understanding
day,
what's coming.
The less variables and the less unknown in life, typically the happier people are going to be, right? When you just know that in something as simple as, I know I'm going to have a good day. I looked at my calendar and I like everything on my calendar and, I've got something fun planned today or whatever. That level of like kind of certainty in just something as simple as, the calendar for a 24-hour period can add a lot of happiness, optimism, and things of that nature to people's lives. And so when you look at that, when you scroll out and look at that big picture of the American dream, in air quotes, so to speak, of course it comes down to planning and understanding the trajectory of your life. We get so caught up in focus, Bill, and the micro. And frankly, this is a little bit preachy, but the more we stick on, news outlets and social media and things like that, the easier it is to kind of get stuck into some of that stuff and to kind of work yourself up. At the end of the day, when you can zoom out, whether it's in financial planning, right, and just kind of looking at the big picture and kind of where everything stands, or it's just your life in general, and all the blessings that we have in life, rather than focusing on the negative things that we've got going on in our life every single day. Because none of us, even the most quote unquote blessed people out there, are the people that you think are the happiest. When you look across kind of the spectrum of your family and friends and colleagues and whatever, and you would point to, well, this person's the one that's got it the most together. This one's the one that's having the most success, or this is the person I would trade, days with or lives with tomorrow because they just seem to have everything together. Every one of those people also has a bunch of negative things going on in their life. It's just part of the deal. So whether it's on the financial side and putting a plan together, or it's just focusing on the big picture of your life and staying positive. I say this on the show all the time. I'm an optimist, but optimism is a choice. It really is. And the most interesting part about optimism to me, Bill, and I think this is a great way to end the show, is pessimism makes you sound smart. It really does. Like when you think about the people, whether they're writing news articles about the markets or they're your neighbor talking about, the economy or whatever's going on, when they talk you through their pessimism or their reason for, not thinking things are going to go positively, it sounds intelligent. It's like, well, this war in Iran is going to do this and this and this, and this is what's going to happen. This is the potential fallout, and we got to be careful of this. And so you got to make these. It's like, oh yeah, that could happen. Whereas an optimist sounds generally dumb. We're just like, well, yeah, I just believe that it's all going to work out. A lot of people are like, well, that's just ignorance. Like you haven't thought through all the possible negative things. I just don't think it's a way to live life. I think that although it can sound really dumb to be an optimist, that it's just a much better way to live life. And from a planning perspective, one of the ways to become an optimist, or from a financial perspective, is by having a plan. And seeing that, look, there's a light at the end of this rainbow. If there may be kind of storms going on in your life right now financially, but if we just kind of let this play out, eventually the clouds are going to clear. And if we kind of keep down this path, things are going to get good. And if you can focus on that long-term trajectory in your financial life and stay out of the immediate, people are just a lot happier in general. Again, financial planning or otherwise.
Yeah, I agree with you. Years ago, when I was much younger and all that, I tend to lean more towards the pessimistic side of things.
Human nature.
But then Yeah, then one day I just woke up and said, man, I'm exhausted. Let's look at the bright side of stuff. And things have gotten better ever since then. So here's the thing. A positive thing for you to do today is to call Brad and his team, because having a plan in place for retirement is going to make you feel a little more optimistic probably than you do right now. 952-522-3868. That's the number for Fiat Wealth Management. If you have saved $250,000 or more, give them a call. Get that complimentary retirement consultation and start getting your plan in place so that you can feel optimistic about how things are going to go once you walk away from that job. 952-522-3868. And with that, my friend, we are out of time again. It goes by so quickly, but always a pleasure to see you.
Yeah, always good to see you too, Bill. Thanks for listening, everybody.
This is Retirement Redefined with Brad Gotto and Fiat Wealth Management on Twin Cities News Talk 1130 and 103.5 FM.